Question 1. An insured in California has purchased a life insurance policy. If the policy includes the standard free look provision, how many days does the insured typically have from the date of policy delivery to return the policy for a full refund? A. 7 days. B. 10 days. C. 20 days. D. 30 days. Answer: B. 10 days. In California, the standard free look period for most individual life insurance policies is 10 days from the date the policy is delivered to the insured. This provision allows the policy owner to review the policy terms and conditions, and if they decide it's not suitable, they can return it for a full refund of all premiums paid. For example, if a policy is delivered on June 1st, the insured has until June 11th to return it. Always remember this crucial consumer protection that ensures buyers have time to reconsider their purchase. Question 2. Which of the following statements regarding the incontestability clause in a California life insurance policy is generally true? A. It prevents the insurer from denying a claim for any reason after the policy has been in force for 1 year. B. It prevents the insurer from denying a claim due to misstatements on the application after 2 years, except for fraud. C. It allows the insurer to contest a claim at any time if a material misrepresentation was made, regardless of policy duration. D. It voids the policy if the insured commits suicide within the first year, but still allows other claims to be contested. Answer: B. It prevents the insurer from denying a claim due to misstatements on the application after 2 years, except for fraud. The incontestability clause dictates that after a life insurance policy has been in force for a specific period, typically 2 years from the issue date, the insurer cannot deny a death claim based on misstatements made in the original application, even if they were material. The key exception to this clause is fraud. If an applicant intentionally committed fraud, the policy can be contested beyond 2 years. This clause provides policyholders with assurance that their death benefit will be paid after a reasonable period, preventing prolonged disputes over application accuracy. Remember, the goal is to protect beneficiaries from delays after the insured's death. Question 3. Under a California life insurance policy, what is the primary purpose of the misstatement of age or sex provision? A. To allow the insurer to deny a claim if the insured's age or sex was incorrectly stated on the application. B. To adjust the policy's face amount or premiums to reflect what would have been purchased at the correct age or sex. C. To penalize the insured for providing incorrect demographic information by reducing the death benefit by 20%. D. To void the policy if the misstatement of age or sex was discovered after the policy's issue date. Answer: B. To adjust the policy's face amount or premiums to reflect what would have been purchased at the correct age or sex. The misstatement of age or sex provision ensures that if the insured's age or sex was incorrectly stated on the application, the policy's death benefit or premiums will be adjusted to what they would have been at the correct age or sex, rather than denying the claim or voiding the policy. For instance, if an insured stated they were 30 but were actually 35, the death benefit would be recalculated to the amount that could have been purchased for the same premium at age 35. This clause prevents an insurer from denying a claim due to an innocent mistake, ensuring fairness to both the insurer and the policy owner. It's a pragmatic solution designed to uphold the original intent of the contract. Question 4. A California resident has a variable life insurance policy. Which of the following statements about the cash value of a variable life policy is true? A. It is guaranteed to grow at a minimum fixed rate, similar to whole life insurance. B. It is invested in the insurer's general account and offers a minimum guaranteed interest rate. C. It fluctuates based on the performance of investments chosen by the policy owner within the separate account. D. It is not accessible until the policy matures or the insured dies. Answer: C. It fluctuates based on the performance of investments chosen by the policy owner within the separate account. Variable life insurance policies allocate their cash values to a separate account, which is comprised of various investment options, such as stocks, bonds, or money market funds, chosen by the policy owner. The cash value of a variable policy is not guaranteed. It can increase or decrease depending on the performance of these underlying investments. For example, if the chosen investments perform well, the cash value could grow significantly, but if they perform poorly, the cash value could decline. This characteristic highlights that the policy owner bears the investment risk, making it a securities-based product requiring a securities license to sell. Question 5. In California, if a life insurance agent recommends replacing an existing life insurance policy with a new one, which of the following is required? A. The agent must always discourage replacement, as it is considered an unfair trade practice. B. The agent must submit a notice regarding replacement to the existing insurer. C. The new insurer must notify the existing insurer of the proposed replacement. D. The agent must provide the applicant with a notice regarding replacement of life insurance or annuities. Answer: D. The agent must provide the applicant with a notice regarding replacement of life insurance or annuities. When a life insurance agent recommends replacing an existing policy with a new one in California, they are legally required to provide the applicant with a notice regarding replacement of life insurance or annuities. This crucial document is designed to inform the applicant of potential disadvantages of replacement, such as new contestability periods, surrender charges on the old policy, or higher premiums due to increased age. For example, the notice helps a consumer understand that they might lose valuable benefits or guarantees from their old policy. This regulation ensures consumer protection and informed decision-making before surrendering an existing policy. Question 6. All of the following are typically considered non-forfeiture options in a whole life insurance policy except A. Cash surrender value. B. Extended term option. C. Reduced paid-up option. D. Automatic premium loan option. Answer: D. Automatic premium loan option. Non-forfeiture options are benefits available to a policy owner who surrenders a cash value life insurance policy, preventing them from forfeiting the built-up cash value. The three standard non-forfeiture options are cash surrender value, extended term, and reduced paid-up. The automatic premium loan option, however, is a policy rider or provision that automatically pays an overdue premium from the policy's cash value to prevent lapse, rather than an option chosen upon surrender. For example, if a policy owner stops paying premiums, they can choose to take the cash, convert to a paid-up policy for a lower face amount, or have the existing face amount continue for a limited term. Question 7. When an applicant for a California life insurance policy signs the application, they are generally affirming that the statements made therein are A. Legally binding guarantees, regardless of intent. B. Representations, true to the best of their knowledge and belief. C. Warranties, which are statements that must be absolutely true. D. Irrevocable offers that cannot be withdrawn once submitted. Answer: B. Representations, true to the best of their knowledge and belief. When an applicant signs a life insurance application in California, they are typically affirming that the statements made are representations, meaning they are true to the best of their knowledge and belief. Unlike warranties, which must be absolutely true and typically relate to the policy's terms, representations are statements made by the applicant that are considered material but not necessarily guaranteed to be flawless. For example, if an applicant states they are in good health but is unaware of an undiagnosed condition, it's a representation, not a breach of warranty. This distinction is important because a misrepresentation, if material and intentional, can still lead to policy rescission, but an innocent misrepresentation usually will not. Question 8. In California, if a life insurance policy lapses due to non-payment of premiums, which of the following provisions allows the policy to be reinstated? A. Grace period. B. Non-forfeiture options. C. Reinstatement clause. D. Incontestability clause. Answer: C. Reinstatement clause. The reinstatement clause allows a policy owner to restore a lapsed life insurance policy to its original condition, typically within a certain period, example 3 to 5 years, after it lapsed due to non-payment of premiums. To reinstate, the insured usually must pay all back premiums with interest, provide proof of insurability, and repay any policy loans. For example, if a policy lapses and the insured's health improves, they might choose to reinstate rather than apply for a new policy, avoiding new fees and possibly a new contestability period. This provision provides a safety net for policy owners who may have experienced temporary financial difficulties. Question 9. An insured in California names their spouse as the primary beneficiary and their child as the contingent beneficiary on their life insurance policy. If both the insured and the primary beneficiary die in the same accident, who will receive the death benefit? A. The insured's estate. B. The contingent beneficiary. C. The primary beneficiary's estate. D. The insurer, as the claim is voided. Answer: B. The contingent beneficiary. In a life insurance policy, if the primary beneficiary predeceases the insured or dies simultaneously with the insured, and the Uniform Simultaneous Death Act or Common Disaster Clause doesn't apply otherwise, the death benefit will then be paid to the contingent beneficiary. The contingent beneficiary is the next in line to receive the proceeds if the primary beneficiary cannot. For instance, if a husband names his wife as primary and their daughter as contingent, and the couple dies in a car accident, the daughter would receive the death benefit. This ensures that the policy proceeds are distributed according to the insured's wishes even if the primary beneficiary is unavailable. Question 10. Which of the following is considered an unfair trade practice in California if committed by a life insurance agent? A. Explaining the benefits of a variable life policy to a client. B. Offering a client a rebate of a portion of their first premium as an inducement to purchase. C. Recommending the purchase of an annuity as a retirement savings vehicle. D. Providing a client with a personalized illustration of policy values. Answer: B. Offering a client a rebate of a portion of their first premium as an inducement to purchase. Offering a rebate, which involves giving a prospective policy owner a portion of the agent's commission or anything of value not specified in the policy as an inducement to purchase, is strictly prohibited and considered an unfair trade practice in California. This practice is illegal because it can lead to unfair discrimination among policyholders and undermine the integrity of the insurance market. For example, an agent offering to pay a client's first month's premium from their own pocket to close a sale would be engaging in rebating. Agents must only offer what is legally allowed within the policy terms and conditions. Question 11. Under California law, an agent must obtain a specific license endorsement to sell which of the following types of life insurance products? A. Whole life insurance. B. Universal life insurance. C. Term life insurance. D. Variable life insurance. Answer: D. Variable life insurance. To sell variable life insurance products in California, an agent must hold not only a life insurance license but also a FINRA, Financial Industry Regulatory Authority, securities license, typically a Series 6 or Series 7. This is because variable life policies involve investment risk, as their cash values are invested in separate accounts and fluctuate based on market performance. For example, a variable life policy's cash value is directly tied to the performance of underlying investment options, unlike traditional life insurance where the insurer guarantees the cash value growth. This dual licensing requirement protects consumers by ensuring agents selling complex investment-linked products are qualified to do so. Question 12. A California insured wants to ensure that the death benefit of their life insurance policy keeps pace with inflation. Which rider would be most appropriate for this purpose? A. Waiver of premium rider. B. Accidental death benefit rider. C. Cost of living adjustment, COLA, rider. D. Guaranteed insurability rider. Answer, C. Cost of living adjustment, COLA, rider. The cost of living adjustment, COLA, rider is designed to automatically increase the face amount of a life insurance policy to help offset the effects of inflation, usually tied to an inflation index like the Consumer Price Index, CPI. This ensures that the purchasing power of the death benefit is maintained over time. For example, if inflation causes $1 to buy less, a COLA rider would increase the policy's death benefit proportionally, preventing the coverage from becoming inadequate in the future. The other riders serve different purposes, such as waiving premiums upon disability or allowing future purchases of additional coverage without proof of insurability. Question 13. Which of the following is the primary purpose of the California Department of Insurance, CDI, regarding life insurance? A. To act as an investment advisor for policyholders. B. To market and sell state-sponsored life insurance plans. C. To regulate the insurance industry and protect consumers. D. To set premium rates for all life insurance products sold in the state. Answer, C. To regulate the insurance industry and protect consumers. The primary purpose of the California Department of Insurance, CDI, headed by the Insurance Commissioner, is to regulate the insurance industry within the state to protect consumers. This involves licensing agents and insurers, approving policy forms, investigating complaints, ensuring solvency of insurers, and enforcing insurance laws and regulations. For instance, the CDI investigates claims of unfair practices against consumers, ensuring they are treated fairly by insurers and agents. Their role is crucial in maintaining a fair and stable insurance market for the benefit of all Californians. Question 14. An individual in California is applying for a life insurance policy and fails to disclose a pre-existing heart condition. This omission, if material and intentional, could be considered A. A warranty. B. An ambiguity. C. A concealment. D. An estoppel. Answer, C. A concealment. Concealment occurs when an applicant intentionally withholds or fails to disclose material facts to the insurer that are relevant to the underwriting decision. If the omission of a pre-existing heart condition is intentional and material, meaning it would have affected the insurer's decision to issue the policy or the premium charged, it could lead to the insurer rescinding the policy. For example, if an applicant knows they have a serious health issue but deliberately doesn't mention it, that's concealment. Always remember that transparency is key in the application process, as failure to disclose material facts can invalidate coverage. Question 15. The grace period in a California life insurance policy typically allows the policy owner how much additional time to pay an overdue premium before the policy lapses? A. 7 days. B. 10 days. C. 31 days. D. 60 days. Answer, C. 31 days. The grace period in a life insurance policy provides a specific period, usually 31 days, after the premium due date during which the policy remains in force, even if the premium has not been paid. If the insured dies during this grace period, the death benefit is still paid, typically with the overdue premium deducted from the proceeds. For example, if a premium is due on May 1st and not paid, the policy would generally remain active until June 1st. This provision protects the policyholder from immediate lapse due to a slight delay in premium payment. Question 16. In California, what is the main characteristic that distinguishes a participating life insurance policy from a non-participating policy? A. Participating policies are typically sold only by stock companies, while non-participating are sold by mutual companies. B. Participating policies pay dividends to policy owners, while non-participating policies do not. C. Participating policies have a guaranteed cash value, while non-participating policies do not. D. Participating policies are usually term life insurance, while non-participating are whole life. Answer, B. Participating policies pay dividends to policy owners, while non-participating policies do not. The key distinction is that participating life insurance policies allow policy owners to participate in the insurer's surplus by receiving dividends, which are essentially a return of a portion of the premium if the insurer's experience, mortality, expenses, investments, is better than anticipated. Non-participating policies, on the other hand, do not pay dividends. For example, a mutual insurance company typically issues participating policies, while a stock insurance company often issues non-participating ones. Dividends are not guaranteed but reflect the insurer's profitability and are not considered taxable income because they are viewed as a refund of an overpayment of premium. Question 17. Which of the following statements about group life insurance in California is generally true? A. Individual medical underwriting is required for each member of the group. B. Each individual receives a separate policy document detailing their coverage. C. The employer is typically the policy owner and receives the master policy. D. Premiums are always higher than comparable individual life insurance policies. Answer: C. The employer is typically the policy owner and receives the master policy. In group life insurance, the employer, or another eligible entity like a labor union or trust, is typically the policy owner, holding the master policy, while individual members receive a certificate of insurance as evidence of their coverage. Group policies are designed to cover multiple individuals under a single contract, often without individual medical underwriting, relying on the group's overall demographics for risk assessment. For instance, a large corporation purchases a group life policy for its employees, managing the administration and premium payments. This structure makes group insurance a cost-effective way to provide coverage to many people. Question 18. Under a California life insurance contract, the transfer of ownership rights from the policy owner to another party is known as A. Endorsement. B. Assignment. C. Revocation. D. Beneficiary change. Answer: B. Assignment. An assignment in a life insurance policy refers to the transfer of all or a portion of the policy owner's rights, such as the right to change beneficiaries, take out loans, or surrender the policy, to another party. This can be absolute, transferring all rights permanently, or collateral, used as security for a loan. For example, a policy owner might assign their policy to a bank as collateral for a mortgage loan. The transfer is legally recognized and allows the policy to be used as a financial asset. Question 19. If a life insurance agent in California is found to have committed twisting, what does this unfair trade practice involve? A. Misrepresenting policy terms to induce a policyholder to lapse or surrender an existing policy for a new one. B. Charging excessive premiums for a life insurance policy compared to industry averages. C. Providing incomplete policy illustrations to clients to make a policy seem more attractive. D. Refusing to issue a policy to an applicant based on their marital status. Answer: A. Misrepresenting policy terms to induce a policyholder to lapse or surrender an existing policy for a new one. Twisting is an illegal unfair trade practice where an agent misrepresents the terms, advantages, or disadvantages of an existing life insurance policy to induce a policyholder to lapse, forfeit, or surrender it to purchase a new one. The new policy is often not in the client's best interest. For example, an agent telling a client their old policy is worthless or obsolete to convince them to buy a new, more expensive one is a classic case of twisting. This practice is prohibited to protect consumers from detrimental policy changes driven by an agent's desire for new commissions. Question 20. Which of the following settlement options would provide a life insurance beneficiary with a guaranteed income for their entire lifetime, regardless of how long they live? A. Fixed period option. B. Fixed amount option. C. Life income option. D. Interest only option. Answer: C. Life income option. The life income option, also known as a straight life annuity option, guarantees the beneficiary a regular income payment for the rest of their natural life, even if they live beyond their life expectancy and exhaust the principal. This option provides the highest degree of security against outliving one's income. For example, a beneficiary could receive a monthly payment for life, ensuring a stable income stream rather than a lump sum. The other options provide payments over a set period, until a certain amount is depleted, or simply pay interest on the death benefit. Question 21. A key person life insurance policy in California is typically purchased by A. The key employee themselves, to protect their family. B. A business, to cover the financial loss that would result from the death of a valuable employee. C. The government, to provide essential benefits to critical public servants. D. A charitable organization, to ensure the continuity of their leadership. Answer: B. A business, to cover the financial loss that would result from the death of a valuable employee. Key person life insurance is a business insurance policy purchased by a business on the life of an employee whose skills, knowledge, or leadership are critical to the company's success. The business is both the policy owner and the beneficiary. For example, if a company's CEO, whose unique vision drives significant revenue, dies, the policy's death benefit would help the company cover financial losses, recruit a replacement, and ensure continuity. This type of policy protects the business from the financial impact of losing a crucial asset. Question 22. All of the following are typically considered dividend options for a participating life insurance policy except A. Cash payment. B. Reduction of premiums. C. One-year term option. D. Conversion to extended term. Answer: D. Conversion to extended term. Dividend options are choices available to a policy owner on how to receive or use their policy's accumulated dividends, which are a return of unused premiums. Common dividend options include receiving cash, applying them to reduce future premiums, allowing them to accumulate at interest, or using them to purchase paid-up additions or one-year term insurance. Conversion to extended term, however, is a non-forfeiture option, which is a choice made when a policy is surrendered due to non-payment, not a dividend option. Understanding this distinction is crucial for identifying how policy values can be utilized. Question 23. An individual in California is comparing a fixed annuity to a variable annuity. The primary difference is that a variable annuity A. Offers a guaranteed minimum interest rate on its cash value. B. Promises a fixed payout amount upon annuitization, regardless of market performance. C. Allows the annuitant to direct the investment of premiums into a separate account. D. Is regulated solely by state insurance departments, not federal securities laws. Answer: C. Allows the annuitant to direct the investment of premiums into a separate account. The primary distinction between a fixed and variable annuity lies in how the premiums are invested and how the cash value grows. A variable annuity places premiums into a separate account, allowing the annuitant to choose from various investment subaccounts, meaning the cash value and ultimately the payout will fluctuate based on the performance of these investments. In contrast, a fixed annuity offers guaranteed interest rates and fixed payout amounts. For example, someone seeking market participation and potentially higher returns, while accepting investment risk, would choose a variable annuity. Question 24. A California agent is selling a life insurance policy to a senior citizen, aged 65 or older. According to California regulations, what is the extended, free look period for this policy? A. 10 days. B. 20 days. C. 30 days. D. 60 days. Answer: C. 30 days. In California, a special consumer protection exists for senior citizens purchasing life insurance and annuities. For individuals aged 60 or older, or 65 or older for specific annuity types, the free look period is extended from the standard 10 days to 30 days. This extended period provides senior buyers with more time to review their policies and ensure they meet their needs without pressure. For example, if a 68-year-old buys a life insurance policy, they would have a full month to decide whether to keep it or return it for a full refund. This regulation reflects the state's commitment to protecting vulnerable populations. Question 25. Under what circumstance would the suicide clause in a California life insurance policy typically allow the insurer to deny a death benefit claim? A. If the insured commits suicide at any time after the policy is issued. B. If the insured commits suicide within the first 2 years of the policy's issue date. C. If the insured commits suicide and was declared insane at the time of death. D. The suicide clause is prohibited in California life insurance policies. Answer: B. If the insured commits suicide within the first 2 years of the policy's issue date. The suicide clause is a standard provision in most life insurance policies that allows the insurer to deny a death benefit claim if the insured commits suicide within a specified period, typically the first 2 years from the policy's issue date. If suicide occurs within this period, the insurer's liability is usually limited to a refund of premiums paid, not the full death benefit. However, if the suicide occurs after this 2-year period, the full death benefit would generally be paid. This clause is designed to prevent individuals from purchasing life insurance with the intent to commit suicide shortly thereafter.